time.
Here's what our attorneys make us say. We believe all the information we offer on this program is factual and up to date. However, we cannot guarantee its accuracy, and you should not think of it as a complete analysis of the subjects discussed. We are also not giving you an offer to buy or sell the investments we talk about. All investments involve varying degrees of risk, and we cannot guarantee any specific investment or strategy will be suitable or profitable for your portfolio. Always consult with a qualified investment, legal, or tax professional before taking any action.
You've worked hard and saved for retirement, but remember, it's what you do with that money that really matters. How will you ensure that you wring every nickel out of your Social Security benefits? Could you pay fewer taxes in retirement? And how and when will you withdraw money from your IRA or 401k? Welcome to Secured Retirement Radio with Joe Lucy of Secured Retirement Financial. Joe's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal, and has nearly 25 years of helping people just like you. This is where you can count on straightforward and objective advice on how to make your money go further in retirement. And now, here's your host, Joe Lucy.
Warren Buffett is probably the most successful investor of our generation, right? Yet his investing principles are surprisingly simple. They're easy for anybody to understand. He's famous for several pieces of advice, and one of my favorite is this. It's good to learn from your own mistakes. It's even better to learn from other people's mistakes. This is especially true when it comes to planning for retirement. Welcome to Secure Retirement Radio. I'm Joe Lucy, certified financial planner. I got Dylan Malberg joining me here this morning in our St. Louis Park studio. And if you plan on retiring anytime in the next 5, even 10 years, you're not going to want to miss a second of today's program. You know, the one thing about making a mistake in retirement is it often comes with a tremendous price tag. And it's difficult and can sometimes be catastrophic and something you can't recover from, especially at this stage of the game. So the good news is this. You're not Christopher Columbus. Millions of Americans have retired before you. You're not going to new ground here. And trust me, there's been a lot of mistakes that we can learn from in the past. So if you know others' missteps, you can prevent yourself from making some of these same mistakes yourself, and you got a much better shot of retiring successfully. And that's what Secured Retirement Radio is all about. So coming up on today's program, we're going to share with you 7 common retirement planning mistakes that could end up costing you a small fortune in retirement.
Morning, Joe.
Morning, Dylan.
The first common mistake around retirement planning that you cannot afford to make is around claiming Social Security at the wrong time. And there's an article from Forbes that says 96% of Americans lose an average of $111,000 in Social Security income just because they're claiming benefits at the wrong time. And you got to ask yourself, I mean, it sounds like a really big mistake to me. And we want to make sure the listeners of Secure Retirement Radio here aren't making that big mistake. And you mentioned that big price tag, and this is just the start of it.
Well, you want to make sure as you transition into retirement that you go from this wealth accumulation mode. That's where you're in your 30s, your 40s, even your early 50s. It's all about how much can I set aside, how much can I get that 401k to grow to. But you need to start to transition to how am I going to replace paychecks, right? Because retirement is really just 30 years of unemployment. And it comes down to what we oftentimes are talking about here on Secure Retirement Radio, a concept I call mailbox income. You need to focus on how do I generate income that I don't have to think about. Money that's going to hit the checkbook each and every month. It doesn't matter what's going on Wall Street and what a crazy week we had this week, pipelines and whatever. That stuff shouldn't derail your retirement. And the way to most easily protect yourselves is to make sure you have money coming in like clockwork. Think Social Security, think pensions. Some of you might have rental income that you can depend on, but it's about this money that doesn't care what's going on Wall Street. Because if you find yourself in a situation where you're taking $3,000, $5,000, $10,000 a month, whatever your number is. And the markets get clobbered. Go back to a year ago when we had the COVID hit, and all of a sudden 37% was evaporated from the market in a matter of just a couple weeks. If you're forced to take that money out, you're locking in losses. You'll never recover that money, even though over the last 12 months we've had a tremendous, V-shaped recovery. You got to start focusing on things that are going to be dependable and making sure that you are looking at mailbox income. And absolutely, Dylan, Social Security has got to be the core foundation for anybody's retirement planning.
Oh, and then everybody seems to get to retirement, and they kind of look at Social Security as being this simple. I'm going to work until I'm 62, 64, 60, whatever your day's going to be, and then we're just going to turn it on, and my spouse is going to turn it on, and we're going to collect, and everything's going to work out the right way. Well, the reality is Social Security isn't simple. There's a lot of things that take into consideration around taxes, Medicare premiums, just the mathematical numbers of how can we get the most out of Social Security.
Well, in going back to this Forbes article you quoted, 96% of Americans are leaving money on the table. I can tell you that 96% of Americans aren't taking their Social Security right away. I mean, we all know that the earlier you take Social Security, if you're just trying to get it right at 62, you're probably going to be leaving money on the table because of the 8% growth and what have you. On the other side of this, the conventional wisdom that everybody should be waiting until both spouses are age 70, mathematically, statistically, historically, we can prove it to you that if you're both waiting till 70, it's very likely that you are also leaving money on the table. The third most common option I see are full retirement age. My full retirement age is 67, so I'm going to take it at 67. If 96% of Americans are taking their Social Security wrong, it means 4% are getting it right. And you need to have a customized analysis on your own situation. A simple spreadsheet does not get you the answer because you start to forget about, or you can't bring in factors like what's going to be future tax rates. Keep in mind, Social Security by itself, 100% tax free. 100%. There isn't any of you listening to us right now here at Security Time Radio that would ever have to file another tax return based on today's tax code if all you needed was your Social Security income. And we've seen families that we've taken from $40,000, $50,000, $70,000, even $80,000 a year of income. That's $80,000 tax free, but it's when that Social Security, when other sources of income start hitting the tax return. Maybe it's your pension, could be that rental income, could be dividends, interest. It could be municipal bonds. Remember, you were told municipal bonds are tax-free. They aren't when it comes to Social Security. It could be required minimum distributions. So the simple spreadsheet isn't going to get you the answer. The only way to get the right answer is to make sure that you are looking at your own personal situation, starting with the goals. Where do you want retirement to look like? How does that all come together? Bringing in life expectancy, of course, and health, but also looking at, taxation and optimizing it. It's not just about getting as much as you can, waiting till 70. Well, that does get you more. You also have to have a life expectancy and think about when what you're giving up in the meantime. So you got to really have a tailored analysis. And that's really what I think we're talking about here this morning, Dylan, as we talk about the 7 common retirement planning mistakes that you can't afford to lose. You got to make sure you get the Social Security piece right.
No, and just like your retirement shouldn't be this one-size-fits-all program that you're in, your Social Security strategy should also be optimized to your specific situation, making sure that you're going to be getting the most out of your benefits.
You might be thinking of this Social Security as just $2,000, $3,000 a month of income. But when you start to consider all the total amounts of lifetime income that this money represents, it's a massive number, and we can't get this wrong. In fact, if you've made an average or even a little bit above average income, your Social Security, the benefits you receive from that, easily exceed several hundred thousands of dollars. Those higher income folks, we see it in the $1 million range. So it's absolutely critical that you get the right information, something that's tailored to your own retirement, and that you get this right. That's why I'd like to make a very special offer here this morning. and it's just for today's listeners. I want to show you how you can get even more income and how you can optimize this mailbox income, which Social Security is the foundation of, with a free customized secured retirement Social Security analysis. Now, the analysis, it'll show you, it'll pinpoint for you the optimal time for you and your spouse, if you're married, to take and elect your benefits. It will consider all the other factors that you have to bring into this. Taxes, required minimum distributions, Medicare premiums, other spousal benefits, and how you can still coordinate some of that. The results, I can't tell you how many times families have come to us and said it was absolutely shocking to them how much different getting a Social Security analysis that's tailored to their situation made a difference. Now, I know there's advisors out there that are charging, I've seen thousands of dollars for this. It's not going to cost you a dime. You leave the checkbook at home, but I want to make sure that you're considering all the factors when it comes to your Social Security. So get the Secured Retirement Social Security analysis. I'm going to ask that you have not already filed for benefits, or that what you or your spouse have not, to take advantage of this. But get your tailored, the customized, the free Social Security analysis by calling 952-777-8838. That's 952-777-8838. If getting Social Security is right for you, if you don't want to fumble when it comes to these 7 critical things, get the Social Security analysis. It's absolutely free. There's no cost, no obligation. 952-777-8838.
When we come back, 57% of Americans make this critical retirement planning mistake, and it's costing them a small fortune.
That there is Dylan Malberg. I'm Joe Lucy, certified financial planner. More with Secure Retirement Radio in just a few moments.
He's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal. And he's no ordinary Joe. You're listening to Joe Lucy on Secured Retirement Radio. Fasten your seatbelts and put your tray tables in an upright and locked position. It's another action-packed segment on how to make your money go further in retirement. You're listening to Secured Retirement Radio.
All right, so according to a Harris poll survey, the majority of Americans rarely consider how much money they're going to end up paying in taxes when they retire. In my opinion, it's probably the biggest oversight we see. Knowing how much money you've saved for retirement is important, but understanding that account balance in the 401k is not all yours. And knowing what the after-tax number looks like is critical. Welcome back to Secure Retirement Radio. I'm Joe Lucy, certified financial planner. I got Dylan Malberg in our St. Louis Park studio. Today, we are talking about how you can avoid seven common mistakes that we are seeing in our offices on a regular basis, and these mistakes can cost you a small fortune. Coming up in this segment, we're going to talk about why you could be paying a whole lot more in taxes than you even realize, plus some tax-saving strategies that can make sure that you have a secured retirement for yourself.
Yeah, and the first common retirement planning mistake we talked about this morning was around Social Security, making sure that you're taking into all the considerations around it and making sure you're not claiming it at the wrong time. And the second common mistake that we see is not having a strategy to reduce taxes in retirement. And there's a recent nationwide survey that basically they found out that 57% of Americans rarely consider just how much taxes that they're going to be paying during retirement. And you talk about expenses in retirement, kind of the first couple of things that come up are maybe health care and maybe inflation. You just maybe have a mortgage that you just got because you bought a condo or something. But we believe here that the biggest expense that you're going to see in retirement is going to be your tax bill, and your tax bill around these retirement accounts that you've saved up for over the years.
We are at 40-year lows, but it's not going to last forever. We threw $6 trillion fighting COVID here. There's another $2 trillion that they keep threatening they're going to pass. Changes to capital gains rates. Of course, they're only going to attack those of you that are making over 400, right? Not a chance. It's going to impact everybody. It's like you got this time bomb and the fuse is starting to go into the bomb, right? You know that this is about to go, and we are going to start seeing substantial tax changes. Now, I can't promise you that, but I'll tell you that if you're an astute investor, if you're somebody that wants to get your retirement planning right, you need to start thinking beyond just wealth accumulation. There's nothing wrong with wealth accumulation, but people tend to hire Secured Retirement Radio because, number one, we understand that nobody wants to reduce their lifestyle, the income that they need. They're not going to substantially reduce expenses. Sure, the mortgage gets paid off, but you'll find something to do with it, and you don't want to live a different lifestyle. Number two, we like to share with people, I hate taxes. I want to share with you how we can substantially reduce taxes. And then the third reason is to grow wealth, but it's never at the compromise of the income or the tax planning that happens. Now, the problem is this. When you start to think about who's going to help you with your retirement planning, who to consult with, a lot of us think that there's really only two levels of service. The basic level is think of the 401k administrator or going directly to Fidelity or Vanguard, E-Trade, Robinhood, and you're making these buy and sell decisions in your investment portfolio, and you're 100% on your own. Maybe you're reading a newsletter or something, but really, if it goes wrong, it's on you. And a lot of you listening to us right now, that's you're fine with that. You're probably pretty good at it. And then there are those that second level where we say, you know what, I think I want some help in this area, so I go and hire myself a wealth manager, somebody that's going to help me with my investment selection. They're going to start to share with me the proper portfolio allocation. But your reviews are, well, they're really around portfolio performance, returns, the wealth accumulation. You know, you'll sit down and they're going to recommend that I think we should make a change of this mutual fund for this mutual fund. Worse, maybe you're paying somebody and they haven't made any changes in decades. But that second level, when you get past where you're doing it on your own and you start to hire somebody that's just helping you with the investment selections, they add a lot of value. But when you start to get to retirement, maybe it's time to start thinking of finding an advisor that's going to help you at the top level. And that top level is when you start to bring in other factors. You start to look at taxes. We start looking at Social Security optimization, like we talked about in the first segment. We're going to start talking about healthcare. We're going to start making sure that the estate planning, that your financial planning is coordinated with your estate planning. So all of this stuff goes smooth. Nobody leaves a mess. When you want to get beyond just the investment strategies and you want to start thinking about how do I take my money back? How do I make it tax efficient? How do I make it last a lifetime? You need to make sure that you're looking for somebody that's operating in that top level. The problem is the vast majority of the retirement consultation is really in those other two levels, right? You're either doing it on your own and you get somebody that's just helping you facilitate the trade, or you got somebody that's an investment strategist that's telling you how to put the portfolio. To reduce taxes, you need to start thinking beyond just wealth accumulation. You need to be proactive about it, and the timing on this couldn't be more critical. I think the taxes are about to go through the roof. I'm not the only one that says this, by the way. David Walker, head controller for two presidents, has said that because of a four-letter word, math, M-A-T-H, we have to start raising taxes. And it's not just going to be for the guy in the big mansion down the street. It's going to hit all of us. And the only way to really protect yourself is to start thinking about repositioning while we still have a chance.
Yeah, and Joe, I want to go back to this time bomb that you mentioned earlier, and the tax code in general. We joke it's written in pencil, could change at any point in time, and you mentioned the math; it has to go up. The other time bomb that's out there is at age 72, when we hit what's called required minimum distributions, and now the IRS is going to say you're going to have to start taking out a certain percentage of these retirement accounts, and you're going to have to pay taxes on it at whatever tax rate you're in. So when we take into consideration and that's, you have to take that money out whether or not you're spending it, or need it or not, and pay taxes on it. And you take into consideration that you're going to have to take money out and pay taxes on it, and the fact that, again, the writing's on the wall, taxes are going up. You put those together, this tax time bomb starts to look even worse and worse as we go forward.
Think about the last couple reviews you've had with your financial professional. Over the last 3 or 4 reviews, how many times have they looked at a tax return? If they're not looking at a tax return, they either don't know taxes or they don't think they're a problem. How many times have they shared with you a projection of required minimum distributions? Do you know what that number is going to look like? Because a lot of families don't. 57% of, based on that nationwide study, are not bringing in tax planning whatsoever in their retirement planning. If you have $1 million in your 401k, at 72, you'll have to start taking out 4%. It's a little less than that, 3.7. But it gets to 4 very quickly, and it goes to 5 by age 80. 4% of $1 million is $40,000. $40,000 that has to come out. It has to hit the tax return. This creates an avalanche in many cases. All of a sudden, we start paying higher Medicare premiums. We get pushed into a higher bracket, makes our capital gains taxable, which they could have been tax-free. Maybe we're paying the extra 3.8% net investment income tax. There's a whole slew of things that you need to start looking at. And with a 40-year low, and more certainty now than ever before. I mean, I've been doing the radio program here for over 12 years, Dylan. I cannot think of a time. I've been in the financial services industry for 25. I can't think of a more clearer time that we are going to see taxes go up, and soon, than right now. You know, if you like the idea of paying zero taxes, and we can help families get to that in many cases, and you would like to substantially, dramatically reduce the potential or even eliminate taxes altogether, you'll get that with what we call the secured retirement tax analysis. Here's how it works. I'm going to gather some basic information from you. We'll bring that information into our lab. We will crunch and grind the numbers, and we will put it into a simple, easy to understand report. Now that when we sit back down with you, you will see exactly how much money you can save with some proactive tax planning. This isn't about taking some simple, obvious deductions that just save you a couple dollars on this year's tax. I'm talking about lifetimes, tens of thousands, I mean hundreds of thousands of dollars in taxation. Now, I'm going to ask that you have at least $500,000 set aside in retirement assets. If you've got $5 million or more, this is essential that you have this. The tax cuts are soon to be chopped back, and you can't wait. Let us show you how you can save hundreds of thousands of dollars in taxation with the simple secure retirement tax analysis. The number is 952-777-8838. That's 952-777-8838.
When we come back, how other retirees are successfully generating income in retirement today.
He's Dylan Malberg. I'm Joe Lucy. More with Secure Retirement Radio after the news here.
He's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal. And he's no ordinary Joe. You're listening to Joe Lucy on Secured Retirement Radio.
Stock.
Social Security, Medicare, taxes, risk, income. This retirement stuff can be complicated. Until now. Welcome back to Secured Retirement Radio with Joe Lucy.
Have you ever felt a southern night?
You know, when it comes to investing and saving for retirement, one of the greatest investors of all time, Warren Buffett, has some strong words of advice for each of us. It's good to learn from your own mistakes. It's even better to learn from somebody else's mistakes. Welcome back to Secured Retirement Radio. I'm Joe Lucy, certified financial planner. I got Dylan Malberg here with me in our St. Louis Park studio. Today, we are talking about how you can avoid 7 common mistakes in retirement, and each of these mistakes can end up costing you a small fortune. It can derail your retirement altogether. Coming up in this segment, The reason most people don't do a good job at generating income in retirement, plus why updating and rebalancing a portfolio right now should be a top priority.
And the third common mistake that we see around retirement planning is just not having a plan to generate income. And if you look at where we're at right now, interest rates, near zero. The Fed has basically said they're going to try and keep it there as long as possible.
It's a penalty, Dylan. It's a penalty on savers.
Especially after the news of inflation the last week, we'll get to later in the show. But the old adage of ways to generate income in retirement they're a lot harder than they are today, if they're even a viable option.
A lot of times I think that we make a mistake at thinking of our net worth statement as an income plan. It's not. The investments and what the 401k has grown to, the 403b, the thrift savings plan, what your retirement accounts are at is different than having an income plan. The wealth management, the investment strategies are very important, but more important is to know how to take this money back. Better yet, how do you take it back tax efficiently? But you got to make sure you got a plan, and it's more than it's got to be documented. Think about which money should you be spending from first. Should you be spending from savings? Should you take it from the Roth? Do you take it from the IRA? Do you take Social Security right away? All of these are very important decisions, and every one of you that are joining us here this morning on Secure Retirement Radio, you all have to have a different strategy than somebody that's listening in the radio to us right now in the next car over, right? Everybody's got their own goals, their own dreams. It has to start with the goals, has to look at each of your specific situations. You need to have a tailored approach to this because, in my opinion, the number one obstacle for anybody retiring, if you're like 74% of all Americans that are somewhat concerned about running out of money in retirement, the only way to solve that is by creating an income plan. You need to start thinking about mailbox income. How do I generate a certain amount of money that's going to hit the checkbook each and every month that's going to help reduce or replace my paychecks in these next 30 years of unemployment? After you get through that, you have to have a sound strategy on how to replace or fill in any kind of gaps, right? If you could get $70,000 out of Social Security, but you want to spend $150 a year, how do I get that other $80,000? How do I do that in such a way that a mistake along the way or uncooperative stock market isn't going to completely derail my plans? The last thing you want to be doing at 75 is figuring out how to start generating income by selling off assets. You need to be thinking about this if you're in the golden decade. If you're within 10 years of retirement, that's the time to start thinking about it. Those of you that are joining us on Secure Retirement Radio this morning that are in your 50s, you are not too old to start or too young to start thinking about this. You need to start thinking about how to do that. Now, if you're retiring next month and you haven't gone through this, it's absolutely critical. You stop what you're doing and you give us a call this morning and schedule a secured retirement income analysis. The number is 952-777-8838, because going into retirement without any kind of income plan at all, that's probably the most catastrophic mistake that we're going to be covering here as we go through the 7 most important mistakes, Dylan.
Well, and we talked about ways to generate income with interest rates where they're at right now, and what we're seeing is a lot of families ending up, creating a plan where maybe they're taking more risk than either they should or they're comfortable with.
And that's exactly what's going on, right? When I'm only getting 0.5% out of a CD, what do I start to do to try to make up for the loss of interest rates? Well, now all of a sudden I start piling in more of my money into the stock market that could be creating a situation where you've got way more risk than you even have an appetite for.
Oh, and that's the fourth common mistake that we see around retirement planning is putting this investment philosophy or your portfolio together with a amount of risk that, again, you don't have the appetite for, or it can make you uncomfortable at times when we're not seeing the markets cooperate as well as we'd like.
As you're creating your income plan, you need to start thinking about 3 different risks that everybody has. There's 3 risks that everybody needs to be bringing into their retirement planning. That very first risk is that and we're going to talk about this later on in the program, is this risk of inflation. How do I make sure I'm earning enough so that I'm not safely losing buying power? right? And historically, we've been told we got to put more money into the stock market, but there's other options out there. We'll get to it. The next risk is risk capacity. This has nothing to do with your risk tolerance. It's risk capacity is that there's a numerical number, and we can help you identify what that number is for you, that if your portfolio ever gets below a certain level due to the stock market or over withdrawing funds or whatever it is, you're going to have to change your retirement. And those aren't fun conversations. We've had to have those in the past with families that are coming to us that haven't had this planning in the past. If you get to a point in your 70s that you find out that you were spending more than you should have in your 60s because nobody helped you with an income plan, and all of a sudden that threshold of the balances on the balance sheet get too low, then you violated risk capacity. So the three risks: risk of inflation, risk capacity, and then the third one, which we're really talking about in this mistake here, making sure that your investment portfolio mirrors your appetite for risk, is a risk tolerance. Risk tolerance is an emotional risk. It has really nothing to do on whether or not you could lose the money. We have families that we work with that they come to us. They say, "Tee it high, Joe. Let it fly. Let's try to turn my $2 million into $6 million. Let's not do it at the risk of the a compromise of the other risks. But if you're in a situation where you've got enough income, sure, let's do it." I've also visited with families that say, "Joe, I don't ever want to lose another nickel. The stock market this week, Joe, scared the heck out of me. I didn't like when everything was shutting down with COVID and I saw my balances collapse. I couldn't even look at the statements anymore." That's risk tolerance. The only way to make sure that you are looking at all three risks is by creating an income plan and bringing that in and statistically, mathematically, historically testing it. Do you know what your portfolio could lose if we see interest rates go up, spike 1%? A lot of us are thinking we're being real cautious by having that total return bond fund, and we're going to get socked in the jaw. Everybody has a plan, right, as Mike Tyson says, until they get hit in the nose. You want to make sure that you're looking at all these risks we're talking about this morning. We talked about making sure that you're getting Social Security. We talked about the second biggest risk, not having a tax plan. The third one, not knowing how to generate enough income, not having a plan around income. This fourth one is about not having a portfolio that mirrors your appetite for risk, and we got three more coming up. But before we go there, think about this. When it comes to investing and saving for retirement, Warren Buffett shares with us that we need to make sure that we learn from our own mistakes, but better yet, let's make sure we're learning from others. And that's what we're doing here on Secure Retirement. We're going through 7 risks and understanding that successful retirements are not built on how much money you've saved necessarily. It's not the balance sheet. It's how you take this money back and make it last a lifetime. It's about your ability to generate income and having a plan on how to do that. I'm going to make a special offer here. If you are the type of person that wants to get everything that you deserve out of your retirement, you cannot afford not to give us a call right now and get a secure retirement income analysis. It's absolutely free. This tailored analysis is going to show you the fastest and safest ways that you could increase your income that you might be overlooking. We're going to show you the key to protecting the principal and yet still being able to grow your wealth. We're going to show you how you can get more income and optimize your Social Security benefits and more. Remember, the analysis is free. There's no obligation, but you'll have to call this morning. If you're the kind of person that wants to get every nickel out of your retirement, don't hesitate. The number's 952-777-8838. That's 952-777-8838. One more time, 952-777-8838 to get your secured retirement income analysis. Don't hesitate.
Inflation hasn't been on anyone's radar for years, but could inflation be a big threat for the next wave of retirees? We'll share the answer when we come back.
Don't go anywhere. More with Secure Retirement Radio in just a few moments.
He's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal. And he's no ordinary Joe. You're listening to Joe Lucy on Secured Retirement Radio.
Outside of taxes, I think it's probably the number one risk that we have to concern ourselves. I guess that makes it the number 2 risk. Anyways, inflation, though, is the fifth mistake we want to make sure people are looking at. Because inflation, you want to know what inflation is? A year ago, gas on a national basis was about $2.25. Today it's at $3. Now, I know that there's this little pipeline thing going on, but it's inflation. I was talking to a neighbor of mine. He works in the automotive industry, selling, distributing stuff. He says that his prices are up 60% over the last year. We're starting to see inflation. Janet Yellen and crew are telling us that, they're okay with 2% inflation. I think we might even be running a little hotter than that. I mean, it doesn't seem to me, when I start looking at things, like I'm starting to notice that things are costing more and more money. And this is the first time in 20 years that we're really starting to see this coming back. And if you're doing the same old thing that you've been doing for the last 10 years and you continue to do it going forward and you're ignoring inflation, this could be maybe one of those most critical mistakes you could be making right now.
Well, and you look at all the stimulus, all the money that's been pumped into the economy, low interest rates, taxes are still low. There's coming out of a pandemic. There's a lot of things out there, and inflation is becoming one of the, biggest concerns that we're going to see over the next 6 to 18 months. And then, eventually there's going to be some pressure that's going to be put on the feds, and are they going to raise interest rates, and what's that going to do to the market and people's portfolios and other fixed income? There's a lot that's going to happen over the next 12 to 18 months around this that we have to make sure we're paying attention to.
What if they start changing capital gains rates? What if all of this kind of starts to pile on top of each other. We're talking here this morning on Secure Retirement Radio. Started off by talking about Warren Buffett and a great saying that he has said. And he says, the greatest, make sure one of the best things you can do is learn from your mistakes. One of the better things you can do is learn from other mistakes. So we've been talking here this morning about 7 critical mistakes that you've got to have on your radar in retirement. Talked a little bit about making sure you're optimizing Social Security, how to reduce taxes, how to make sure you've got an income plan in place so that you can generate enough income that you can spend in confidence, how to make sure that your portfolios mirror your appetite for risk, how to make sure you've got future costs of health care, possibly long-term care, how to look at inflation. And the last one that we really wanted to talk about this morning was what's termed as sequence of returns risk, because ignoring sequence of returns risk, if you're in a golden decade, if you're within 10 years of retirement and you are still running along on the portfolio as fast as you can, that's got you to a certain point here. But a drop in the stock market early in retirement or right before retirement is even worse. Can completely change what retirement's going to look like for you. Sequence of returns is the market comes down and you're forced to lock in losses because you have to take income. And we have to make sure we got a plan in place. You need to have a plan in place on how to make sure that you're addressing this.
Yeah, and really what it comes down to is making sure we work with someone that's taking into consideration all 7 of these common mistakes that we see, and making sure that regardless of when you retire or what environment you retire into, you're going to have the confidence that you're going to be able to retire. And you're not going to have to go back to work. You'll be able to retire, spend in confidence, and retire securely.
We have room on the calendars this week for just 5 more appointments. We've had some calls throughout the show. I want to make sure that if these 7 mistakes are important to you, that we help you help create some value for you so you can start to address them. Because growing your retirement savings is more challenging today than it ever has been. You may not realize it, but the fastest and safest way to actually grow your nest egg could actually be focusing on taxes. We've got 40-year lows on taxes and $6 trillion thrown into the economy to combat COVID. A new administration that's promising to raise taxes. I want to help you reduce, maybe even eliminate taxes altogether in your retirement with a free secured retirement tax analysis. It's very simple, very easy, very painless. Just need to gather some information from you. We'll bring it back to the labs. I'll crunch the numbers. We'll sit down again. We can do that virtually. We can do it face-to-face. And we will share with you exactly how much money you could be saving with the proactive tax approach. Numbers say that 57% of us have no tax plan whatsoever. We are not even working with a CPA on any of this. I want to make sure that we get that corrected for you today. Give us a call, get the Secured Retirement Tax Analysis. You have nothing to lose. There's no cost, there's no obligation, but you'll have to call this morning at 952-777-8838. You'll have to be one of the next 5 callers. That's all we have room on the counters for this week. 952-777-8838 to get your Secured Retirement Look Forward Tax Analysis. That's all we have time for this week. We'll be back next Saturday with more from Secured Retirement Radio. Enjoy the beautiful...
Broadcasting on AM 1130, 103.5 FM, 100.3 HD2, and worldwide on iHeartRadio. This is the Twin Cities News Talk Station, KTLK AM, Minneapolis.
More rockets and more unrest. I'm Pam Puso, Fox News. Since yesterday, some